Welcome to this James Cooper Creston webinar on managing corporation tax through COVID-19. Thank you so much for joining us, and I hope you are all staying safe and well through these extraordinary times in which we find ourselves. For those I haven't had the pleasure of meeting before, my name is Sharon Bedford, and I am a tax partner in the business tax team here at James Cooper Creston. I guess if, like me, you're following the newspapers, then you'll see much of the press coverage around the government's coronavirus initiative is centred around the coronavirus job retention scheme. As you probably know, this allows support to pay furloughed staff. And also there's been lots of press coverage about the coronavirus business interruption loan scheme, or CBILS, which provides government-backed partial guaranteed loans to viable businesses. There's been less said about taxes, but there is help available for taxes too. So, for example, on the 20th of March, it was announced that VAT return payments are suspended for all registered businesses until June 2020. And those of you with self-assessment tax payments due on the 31st of July 2020 can have these deferred to the 31st of January 2021. This has been mentioned, however, about corporation tax. However, for many businesses, it is a significant cost. And therefore, we thought it might be helpful to put on a short webinar to hopefully give you some idea about managing this cost, and more importantly, the associated cash flow. So what do we want to have a quick look at this morning? Well, first of all, I want to spend a few minutes talking about how you might defer your corporation tax payments, both generally as using the time to pay initiative, and also just a brief mention if you are one of the large companies who are in the quarterly instalment payment regime. And then want to have a think about the utilisation of tax losses. Have a quick chat about the R&D tax credits. Look at some potential issues that might arise if you do business internationally. And then just briefly at the end, talk a little bit about share option plans. So starting then with time to pay. The government and HMRC have said that all businesses in financial distress and with outstanding tax liabilities can contact HMRC and see if they can take advantage of their time to pay service. Many of you may have already contacted the helpline with respect to your payroll taxes, but this applies equally to corporation tax. And you can see there that on the slide there is the dedicated tax deferral line number, which has been set up by HMRC and which hopefully will give you access through to someone that you can discuss time to pay with. Our experience of this is that you actually have to hang on for quite a long time, so it might be worth making a cup of coffee before you do the dial. But anyway, that is a dedicated number and it is manned. And when you do get through, generally the response is very good. So time to pay for corporation tax isn't new. It's not something that's new or different. But what we are finding is it's much easier to obtain time to pay currently than it has been in the past. What, in our experience, HMRC are agreeing to is that you can spread your corporation tax payments over instalments, and generally they are allowing those instalments not to start for a number of months. What we're finding is that a minimum 2 months deferral should be available, although HMRC's website's just been updated to say 3 months. So certainly there is no issue with asking for more if you require it. What I would stress though, if you are making those calls, is be prepared with information. Although it is generally the case that the people on the other end of the line are very helpful and are agreeing to the time to pay reasonably, in a reasonably flexible way, they are no doubt asking information. And one of the things that they will want to know is how your business has been impacted by the current crisis. Unfortunately, for most businesses, that isn't difficult to explain, but nevertheless, you know, that may be asked. Also, they may ask issues about cash flow and how that is panning out, and other such matters. We've been asked by quite a few of clients about when you should call the helpline in relation to corporation tax. And what I would recommend on that is that you give them a call once you know what your liability is, but before it actually comes due. It's much easier for them to defer it for you if it's not actually got to the due date. As you're probably aware, most companies have to pay their corporation tax 9 months after the end of their accounting period, and therefore perhaps 2 or 3 weeks out from before that, it's worth giving the helpline a call and actually discussing, you know, the time to pay you need and what sort of instalment payments and deferral you might require. We have been asked by a couple of clients whether it's actually worth filing corporation tax returns late, such that the revenue doesn't know that there's a tax liability. So obviously, as I've just mentioned, you pay the corporation tax 9 months after the year end, but you don't have to file your tax return until 12 months after. And typically, although you might get reminder notices, the revenue doesn't start chasing for the tax until after it knows the exact amount of the liability. However, that's not something that we are recommending, because if you do that, the second that the revenue was to get your tax return, they can see that the tax is overdue and therefore will want to chase it quite aggressively. It's much better to actually you know, file relatively early to crystallise everyone's mind what the liability is, and then ask for officially for deferral. One thing just to bear in mind if you do go for the time to pay arrangement is that late interest will apply on that. It's not a deferral like, for instance, the one available on self-assessment income tax returns, where it's just deferred out by 6 months and no interest will apply. On this one, late interest will apply, and the interest rate currently is 2.6%. Just a brief mention about companies that are in the quarterly instalment payment regime. Companies with larger profits have to pay corporation tax by quarterly instalments, and those quarterly instalments are based on forecast corporation tax liabilities. Some of them are payable within the accounting period and some after the accounting period. So if you think about it, if your taxable profits are now forecast to be lower, or you are no longer forecasting a profit for the current accounting period, then it's possible that you've overpaid earlier quarterly instalment payments. And there's two things that's open to you. You can either reduce subsequent payments, such that you know, if you still think you've got a liability and you think you've paid too much in the first 2 quarters, for instance, you could pay less in the 3rd or 4th quarter. But if you think you've paid too much in total, then it's possible to call HMRC and request repayment of quips already made. This is an automatic right available anyway to all taxpayers, but what we are finding is that there's little resistance from HMRC to making those repayments. So if you are in the quips regime, then do have a look, and if you need any help or assistance with that, then do give us a call and we can help you. Again, if you do get it wrong and you underpay quips, then interest is likely to apply again, but the rate there is a little bit lower at 1.1%. Now, I hope it's not the case with any of you, but of course it is the possibility that going through the situation we're in at the moment means that in the current accounting period you may well make a trading tax loss. And therefore it's important to think what you might want to do with that. Now, tax losses can be carried forward and offset against taxable profits in future periods, but obviously that doesn't really have a cash flow advantage to the companies. Alternatively, what you can do is carry back those losses and try and get some tax repaid for the previous accounting period, if indeed that previous accounting period was in profit. And what we found that some companies are doing are wanting to accelerate through getting those accounts done over the next few months so that they can actually make those carryback claims. Unfortunately, HMRC won't accept a carryback claim based on management accounts or anything like that. They will insist on corporation tax returns and accounts being filed with them before that they will formally action a carryback and repayment. However, that necessarily isn't the end of the story, because you may be able to have informal discussions if you haven't paid the prior year tax about maybe moving that payment out further if you do anticipate losses in the next period. So definitely, if you are unfortunately in that position, do have a chat, and what we can help you do is map out the timing of how you might be able to utilise those losses. For companies in group, there might be even more flexibility by a bit more managing in the group, relieving the losses between companies to access those carrybacks. And typically, if you are in a position where you are getting tax back from HMRC, we're finding that they're generally processing those claims within 4 to 6 weeks now, so which is actually speeded up a bit from where they were before. I briefly wanted to touch also on research and development tax credits. Some of you may know that these are available to innovative companies undertaking qualifying R&D. And to undertake qualifying R&D means that you're undertaking projects that seek an advance in science or technology, or one with an aim to resolving scientific or technological uncertainties. It doesn't have to be rocket science to be eligible. I think one of the myths surrounding R&D is it's for people who are in labs and with experimenting with test tubes in white coats, etc. And that's definitely not the case. We process an awful lot of R&D tax credits for a number of our clients across an absolutely wide spectrum of industries, and have been quite innovative in how we can access what is a valuable cash flow advantage for our clients. I think from January alone, we've got several millions of money back for quite a few of our clients, so definitely worth thinking about. And perhaps if you're not in, if you've not got R&D tax credits before, thought, well, perhaps it's a little bit too much back, or it's a little bit marginal, certainly it's worth re-examining. Because what happens if you can get an R&D tax credit claim, then you can reduce your tax bill by generating up to 24.7p in the pound for every pound spent. And indeed, if you're not tax paying, if you're loss making, then you can make claims to get cash back from HMRC, and that equates to 33.3p for every pound spent. So absolutely worth investigating. What we're finding is clients, excuse me, that are in the R&D regime and are making those claims, is that they're also wanting to accelerate their compliance process to maximise the cash flow benefits. You can't access the R&D money currently, although there is some lobbying going on to to HMRC and the government to change that, but the current rule is you can't get any of your R&D money back until you have filed accounts and tax comps with HMRC. So if you are in the position where you are anticipating big repayments, certainly worth getting that in very quickly. There was some initial concern when we first, when all these announcements were first made about government grants and R&D claims, because sometimes when you get government grants, that can affect the amount of R&D that you can claim. And there was a concern that the government-backed CBILS loans were actually potentially going to be damaging to companies that have R&D claims, and that was putting some of those companies off thinking about CBILS loans. However, the HMRC seemed to have confirmed that if you get the CBILS loan just generally for your business and not specific to a specific R&D project, that won't scupper your R&D tax credit claims. However, it is a little bit of a moving situation. So if you are in that position, please talk to us and we'll advise you further. Just wanted to briefly touch on a couple of international issues, specifically to do with corporation tax. So within international tax, rules exist to assign taxing rights where income could be argued to rise in more than one location. So for instance, if you had, say, a company that was incorporated in, let's say, the Netherlands, for instance, but also had a lot of its operations in the UK, there would be a debate as to whether profits from that company should be tax and profits from that company should be paid to the Netherlands, should be paid to the UK, or indeed should be split between the two. And typically that works. There's two concepts. One is where the company is residence, and one is whether that company is deemed to have a taxable presence, or you might have heard the term permanent establishment in another territory. And both those concepts broadly work on where people are making decisions from and where they are carrying out operations from. And there is quite a lot of international tax concern with people being trapped in various countries and not being able to move between countries at the moment, that there will be unintended consequences of that on how international companies are taxed. The OECD have published guidance on this, and if it's an area that concerns you, it's certainly worth following up on. They have said that they are hopeful that there'll be no intended tax consequences of the situation, but because many of the double tax treaties don't have specific clauses to deal with this, then they can't guarantee that. These issues, both corporate residency and permanent establishment, are complex, and we would certainly recommend specific advice is taken if you find yourself in this situation. Just before I finish then, very, very briefly, I just wanted to talk through just a couple of things for those of you that might have EMI share options or other share options. Apologies if this is a little bit off-piste, but we are finding a lot of questions coming through from clients on this, and I thought it might be just worth covering it. So EMI share schemes are tax-efficient share option plans, which are a very tax-efficient way to incentivize your staff. What we're finding is clients are wanting to either possibly introduce the schemes or make some more grants currently, for two reasons really. One, because they're finding that it's helpful to be able to offer staff who otherwise might be having to take pay cuts or be etc., something in, as a bonus sort of incentive that doesn't involve paying out cash to them now. But also because when you grant options, it very much depends on the circumstances of the company at the time to determine the strike price for those exercise of options. And clearly, in the current economic circumstances, some companies are thinking that maybe they could have a lower strike price or exercise price that is than they have historically, and that might also be a benefit for their staff. So if you are in that situation, certainly, have a chat and have a think, because it is something, as I say, that I think is important, whether it's one for this month or, the next couple of months as we start coming out of lockdown and other issues. Obviously is for you to decide, but certainly don't forget them as a way to try and thank your staff for helping you through what may be difficult times. There's just one slight issue on EMI schemes in that just how they might work with furloughed staff, but the representative bodies have asked HMRC for a view on that, and we very much expect a common sense response from them, which will hopefully confirm that putting staff on furlough doesn't upset their EMI incentives. But as yet, we're just still waiting for confirmation from HMRC on that. So anyway, thank you for listening. That's all I wanted to go through on the slides and cover. But Lizzie, I was just wondering, have we got any questions just to that people might have asked?
Hi Sharon. No, we haven't had any questions today, so that's fine.
Lizzie, I don't think.
Hi Sharon.
Well, I've not heard from Lizzie, so I assume that there is no questions that anyone's asked. Sorry if it's a breakdown in communication and some of you have asked questions, but we will have a note of them and we'll get back to you individually on those. So I just, before you all go, just like to say thank you very much for joining us today. If you do have any questions at all, there's my details on the slide. You can contact me or indeed go via our website or speak to your normal James Cooper Creston contact. Again, thank you very much for listening, and I do very much hope that you and your businesses stay healthy and safe through the coming weeks and months. Thank you. Bye-bye.